So once again, good evening, friends. Welcome to the first virtual webinar that AcuPro Consulting is hosting. We've chosen this topic of base erosion profit shifting because this has suddenly assumed a lot of prominence, especially after the multilateral instrument coming into effect. And while we've been hearing about this base erosion profit shifting for the last several years, I think now is the time to actually get an understanding of what this is all about. The way I wanted to run this webinar was basically in two parts, and I didn't want to take too much of your time, and that's the reason we kept it for 1 hour to start with, and then we'll see how things go, and then maybe we can keep another session of this. So base erosion profit shifting, what do you exactly mean? As the name suggests, what happens is multinational enterprises tend to erode their base in a particular country and shift profits to low tax jurisdictions or no tax jurisdictions so as to avoid taxes, or I mean that could also amount to some amount of tax planning. Now this was an issue, or this was a problem which was grappling the world, and multinational enterprises did a lot of tax planning to shift their profits to so-called tax havens, and this actually resulted in governments getting worried about the way businesses were being carried on. This led to lack of competition, this led to lack of transparency, this led to low tax collections, and these all resulted in certain imbalances which was certainly not desirable from an economic standpoint. So while individual companies or multinationals benefited out of this planning, the economics as a whole did not gain from this, and there was unfair allocation of taxable or tax between countries, and the countries naturally wanted to address this issue, and therefore this whole BEPS project was initiated. So let me begin with something very fundamental. So I think the first question that I want to ask is, why should there be taxation? Why should there be taxation? I mean, that nothing can be more fundamental than this. So let me take you through two cycles. I mean, these are economic concepts, but it's important to get the context of what BEPS is all about. Now look at, if there is a fair taxation on business profits, what happens? It enables shifting of resources. Resources means your money or the tax amount from the enterprises to the state. What does the state do out of that? The state uses that tax money to maintain and develop public goods, to maintain and develop public infrastructure. It uses that for maintenance of law and order. It uses it for protection of your property. It uses for enforcement of contracts, and it also uses for stabilizing from a macroeconomic standpoint. So it kind of helps the poor with those tax money so that there is the imbalance which is created gets somewhat addressed. All this happens with the taxes which is paid by multinationals to a particular country. Now, what does it result into? It results into efficient functioning of markets, because if people are able to get money and There is law and order in the country. There is protection of property. There is enforcement of contracts. The markets function efficiently, and that results in facilitating economic growth. Now, when this happens, this increases disposable income of people and thereby spurs demand within the economy. And this leads to even greater profits for the enterprise, because if there is more demand, there is more revenue for the enterprise, and therefore more profits for the enterprise. So you can see this is a virtuous cycle wherein there is a win-win situation for all stakeholders. Now, imagine a situation where this doesn't happen. What happens? There is an imbalance or unfair allocation of taxing rights to a country. So a multinational arranges its affairs in a manner that all the profits get taxed in a low or no tax jurisdiction, while uh, the economic activity happens in some other jurisdiction. And because it has arranged its affairs in that particular manner, the place where the economic activity happens, that country doesn't get its fair share of tax revenue. Now, if there is an imbalance of taxes or the tax collection in a particular country, especially the country where there is a market jurisdiction, there is a loss of tax revenue, definitely. And this leads to that country increasing the tax rates for its domestic companies, because it has to get the resources to run the country and to do all those 5 things that we discussed in the previous slide. Now, when the tax rates increase in that particular country, the local enterprises or the domestic enterprises are put at a disadvantage vis-a-vis the foreign enterprise, because the foreign enterprise doesn't suffer a tax and it can sell its products uh, at a cheaper rate as compared to a domestic enterprise. This leads to a reduced competitiveness. This adversely impacts the economic development or growth of the country, because the country doesn't get its fair share of tax revenues, and which precipitates downward spiral of economy, which in turn reduces the demand. Now what happens? There is demand which goes down. Now if the demand goes down, the demand for the products of that multinational enterprise will also come down, and which means it will have a lower profit, because if there is no demand, there is no sale. Then you see this is a vicious cycle. There is stress in the entire cycle. No one is happy in this case. Now, so you would understand that why is taxation important and why is fair taxation important. Now, having given this context, now I think we can move to what is international tax and what is happening there. Now, the two most prevalent systems of taxation: worldwide taxation and territorial taxation. We've all heard about worldwide taxation. So in worldwide taxation, what happens is that corporations deemed uh, as resident in a state are taxed uh, by that by the resident country, and they are taxed in respect of their worldwide income. So even if they earn an income outside their country, they are taxed in their resident country. But what the resident country does is it seeks to give them a credit of the taxes that they pay in the other countries. And sometimes this is the taxes are deferred because the multinational may not repatriate the profits fully to the home country. So in that form, uh, this is how worldwide taxation happens. So a resident country exercises the power to tax its resident over their entire income, whether that income is earned in that country or it's earned in a different country. Now, what is territorial taxation? Uh, so a pure version imposes tax on active income, which is earned outside their state of residence only in the source state, which means the resident country will not tax income which arises in a country outside that jurisdiction. So which means the resident country will only tax income which is generated in its own territory, while the other country will tax income that is generated in the other territory. So in this case, obviously, because each country is taxing income which is generated in their own territory, there is no question of giving a credit of taxes. And in this form of taxation, uh, there is no taxation on dividend repatriation also. Now, out of these two different prevalent systems of taxation, worldwide taxation is the most common taxation which is used. India uses worldwide taxation. There are certain countries who use territorial taxation in a limited form, and for example, Singapore. But worldwide taxation is what most of the countries prefer, and they prefer primarily because a lot of these countries or the developed countries uh, actually export capital, actually export uh, human capital, uh, technology, and they all want a share of income from that or share of taxes from that, and therefore uh, they all argue that these are incomes earned by my residents, and therefore I should get a share of taxes from the income that they earn. So here, this is the genesis of international taxation. So when there are payments between uh, two cross-border entities, and there are transactions which are cross-border, whatever taxation that happens, that is considered as international taxation. Now, it is not a different tax, so there is no other body which is sitting and levying an international tax on such transactions. This is definitely domestic tax, but way the tax systems of two countries interact to ensure that there is no double taxation, that all study is what international tax is all about. So in a very small example, if company A sells goods to company B and company B makes a payment, so company A earns an income, and company A being a resident of country A will say that uh, you should pay taxes in my country, while uh, the country B in which company B, uh,
Hello.
that country will say this
Sir,
income
I
has
don't know.
in my source, and therefore I should be allowed to charge taxes on this particular transaction. So now, what is the international tax law? So traditionally, it refers to treaty provisions relating to international taxation. It includes domestic legislation governing foreign income of non-residents. It includes domestic legislation and treaty provisions containing rules against international tax avoidance and evasion. Uh, it also includes network of DTAs, uh, cooperation and coordination of tax policies and rules across countries with disparate tax systems. So all this put together is international tax law. Now, international tax law has evolved over the years, and it has evolved to resolve conflicts of national interest. And we've all seen how it's evolved over the years, right from 1920s. when the first model double taxation about convention was drafted. It would include multilateral international agreements. Vienna Convention is one example. Then you have the DTA or the treaty network, and then there's customary international law and general principles of law, which are followed while interpreting treaties or applying treaties. Now we've seen that a legitimate tax claim of a country that should be either based on a relationship to a person or based on the connection of that income to that territory. And this is where international tax comes into play, because one country claims taxation on the basis of residential status of a person who earns the income, while the other country claims taxation on the basis of the source of income, i.e., the place from where that income gets generated. Now, why was the need for treaties? The need for treaties arose because they wanted to reach a consensus and prevent current and potential double taxation. So as to enhance cross-border trade, afford movement of capital, people. This is what the treaty's purpose was. And if you look at the three basic features that a tax policy or a tax framework should have, it should have equity and fairness. And when we talk about international equity, it means the aim should be to ensure that each country receives an equitable share of tax revenues from cross-border transactions. There should be neutrality and efficiency. So your system should be such that it doesn't have a bias towards a particular taxpayer. And it should be efficient, which means that it should be cumbersome, it should be easy to comply with. And one of the very important purposes of the treaty was, or still is, promotion of mutual economic relations, trade and investment. So with these features, the treaties were entered into, and the primary aim was to avoid double taxation. And how was that done? The countries got together and bilaterally agreed that, okay, on income A, you tax, on income B, I will tax, on income C, you tax up to so much amount or so much percentage, and on income C, I will tax the balance. Or on income D, you don't tax, income D, I will tax. So similar. So it was more of a distributive rule or a assignment rule which was agreed between the parties as to how the taxing rights should be allocated between the two countries. And the two countries being the residence country and the source country. And one of the other functions of the treaty was exchange of information to combat tax avoidance and tax evasion. Even though this has been one of the stated purposes of the treaty, this was never being implemented in the right manner because the countries were more keen in attracting investments and businesses in their countries. And even though this was one of the objectives, there was no mechanism to actually gain information about what kind of tax avoidance or evasion strategies are being utilized by the multinational enterprises. So what happened? Over the years, multinationals exploited the gaps in domestic tax laws of countries, made use of favorable tax treaties to shift profits to low or no tax jurisdictions to reduce their taxes, and because of this, disparity in the tax systems of two jurisdictions and the treaty benefits that one could avail by way of treaty shopping and other measures. There was a stress which was being felt by governments because suddenly the tax revenues started dipping. And suddenly what started to happen was uh, while the multinationals reduced their effective tax rates to almost negligible amounts, uh, countries which had to spend a lot on infrastructure and other areas, they were feeling the heat because they weren't any sufficient tax revenues. Now, I mean, I'll just illustrate this with uh, a famous or a celebrated case had been in the news for a significant amount of time, and which, to my mind, was one of the reasons why BEPS happened. So this is the case of Apple. Uh, this is a case of Apple, and we all know Apple is headquartered in the US. So what was what Apple did was it set up an Irish subsidiary or a subsidiary in Ireland. Uh, and in this particular slide, you will see Apple Operations International. Now, this subsidiary had another subsidiary or another three subsidiaries. Apple Operations Europe, again a company incorporated in Ireland. Apple Distribution International, again a company incorporated in Ireland. And Apple Retail Holding Europe, which was again in Ireland. And Apple Operations Europe had another subsidiary, Apple Sales International. And this was the entity which actually did sales across the world. And then they had distributors across the world, including India, including China. And the Apple Retail Holdings Europe had step-down subsidiaries in almost all European countries. If you look at the star, uh, there is one star which indicates that these entities, though incorporated in Ireland, did not have their tax residence in Ireland. While the companies wherein there are two stars or two asterisks, these companies had their tax residence in Ireland. Now, this is the basic structure. I just wanted to draw your attention to this structure before we start to discuss what Apple did. Uh, so Apple had its headquarters at California. Almost all its employees, all its research activity happened in California. Its engineers, all major R&D activity happened in US. There was only some minimal activity which was conducted in Ireland at the ASI and AUE level, and there was very minimal physical presence in Ireland. So what was done was Apple Inc. entered into a cost-sharing arrangement with AOE and its subsidiary ASI. And if you look at that, what was that cost-sharing agreement? Both the entities agreed to share around $4 billion with Apple Inc. So that they could benefit from the R&D which Apple Inc. did at the US level. Now, one could note that even though these entities had an earnings of around 34 billion or 74 billion, 38 billion, what they did by way of cost sharing was that we shared $4 billion with the US entity. The rest all remained in Ireland. And in return for this cost sharing, what they got was they were granted economic rights to use the resulting intellectual property. So they could get the Apple products manufactured from a third-party manufacturer and then sell them across the world. So this was the structure which Apple had put in place. Now, what happened after that? If you look at now, what's the tax law in both the countries? Let's look at that tax law in both the countries. Now, Ireland uses a management and control test to determine tax residency, while US determines tax residency based on entity's place of formation. So what they did, they said AOI is managed from US, even though it is incorporated in Ireland. It is not a tax resident of Ireland. Similarly, they said AOI is incorporated in Ireland and it is not incorporated in US. Therefore, it is not a tax resident of US, which means AOI was not a tax resident of any of these two countries. Now, if you come to think of it, how would worldwide taxation happen? What can happen is only source-based taxation. Now, let's move ahead. So as I mentioned, for the majority of Apple products, ASI contracted with third-party manufacturers in China to assemble the finished goods. Then ASI purchased these goods and then sold them throughout Europe, Middle East, Africa, India. They took the title of the finished goods and then they sold them to the appropriate distribution entity. And in most cases, there was no physical movement of these goods to Ireland. So these goods were all directly shipped to the distributors. Now, what had Apple done? Apple had negotiated with the Irish government an income tax rate of less than 2%. So it is possible that in some countries you can go and sit across the table and negotiate with the government that, look, I want to come and do this in my country. Can you offer me a better tax rate? And that is something which Ireland did, because Ireland treated Apple as a corporate guest, and they were happy to extend this benefit to Apple. And Apple negotiated a 2% rate with Ireland, even though its own domestic tax rate was 12.5%, and the tax rates in European countries and US was even higher. So on account of this arrangement, ASI almost received 36 billion in income, $36 billion in income, on which almost nil or negligible tax was paid. And this was going on since almost 10 years. And they were able to reduce their tax costs substantially. So what happened was the European Commission, one of the commissioners of the competition law, so she came across this structure of Apple and they passed an order stating that Ireland granted undue tax benefits of up to $13 billion to Apple, and that should be recovered. Now, look at the turn of events. It is European Commission which is passing an order stating that Apple has evaded tax to the extent of $13 billion. And Ireland has facilitated that in form of reduction of their tax rates. And therefore, Ireland should recover. Now, if you look at it, the tax rates were actually taxes that were on account of income which was earned in several jurisdictions. So in several jurisdictions, income was earned, but no taxes were paid, and all income was accumulated at the Ireland level. And in Ireland, there were almost negligible taxes. So even though transactions worth billions of dollars happened, there was no tax revenue for the country or all these countries. And another thing which happened was AOE and ASI, they paid only Irish tax on business carried out in Ireland, because Ireland does not make a claim of tax on non-resident Irish company on non-Irish taxes, on non-Irish income. Now these were non-resident companies because their place of management was outside Ireland, and the income that they earned from sale of these products from outside Ireland was again an income which was earned outside Ireland. Therefore, there was no taxation on that. Now, what happened in US? I'm sure a few of you would be aware of Subpart F rule, which is in place in US. So essentially, this rule says when a CFC earns Subpart F income, the US parent as a shareholder is treated as having received that current income. Now, Subpart F was enacted to deter these taxpayers from using controlled foreign corporations located in tax havens to accumulate earnings that could have accumulated in the US. Now, this rule was subverted by Apple by using the checkbox, and also by taking the position that the income that ASI earned was active income and not passive income, because CFC rule applied only to passive income. So I'm not discussing too much on this. I'm just trying to say Apple did. So they did not pay taxes in Ireland. They did not pay taxes in US by using these rules. And in this whole process, they avoided tax of billions of dollars by exploiting the gaps in the domestic tax law systems of the two countries. So in one country, they said, in both the countries, they said we are not residents of that country, and therefore any income that I earn is not taxable in that country. So this was a perfect example where multinationals exploited the gaps in the domestic tax law system to avail a tax advantage. So this is something which happened in Starbucks. This is something which happened in some other entities also. And this all led to the formation of, or this led to the initiation of BEPS project. And this is what I want to touch upon, giving you this context. Now, why was the need for BEPS initiative in international taxation? We've all seen what Apple had done. So there was competition between countries to attract investment or businesses, and which led to domestic laws of countries being relaxed, and they were relaxed in a manner that led to exploitation of the systems by multinational enterprises, because there were mismatches between the tax rules of different countries, and in the process they could artificially reduce the taxable income. there was also increasing feeling that the treaties were being abused by multinational enterprises. The treaties was felt that the treaties may have gone too far in their original motivation to encourage free flow of investment. Uh, and India-Mauritius pre-amended treaty has been a live example because the treaty was used for double non-taxation or treaty shopping, and this use was impliedly also blessed by the Supreme Court in the case of Azadi Bachao Andolan. So that was also a feeling among countries that apart from multinationals exploiting the mismatches in the domestic tax law systems, they were also abusing the provisions in the tax treaties. And what also came to be understood by governments was that minimizing tax burden has come to be viewed by many multinationals as a good business practice, and they view tax cost as just another business cost which will be reduced come what may. And accordingly, business transactions were structured in a manner to primarily reduce the tax incidence. And even if it meant that they create structures which did not have any commercial rationale or did not have any economic rationale to it. And so those were structures in form, but in substance, those structures did not have any weight. So with this, the countries got together. The G20 countries got together, and that also included India. And they came up with a BEPS action plan. Uh, so BEPS as base erosion and profit shifting. This is a phrase which is commonly used to refer to tax avoidance strategies, aggressive tax planning used by multinational corporations to shift their profit from high tax jurisdictions to lower tax jurisdictions so as to minimize tax incidence. So essentially, what BEPS actually goes is that it should be taxation at the jurisdiction where value is created, where substance is present, and not just because a particular entity is incorporated in a country and that entity in form gets the income. So basically, they look at what is the substance and not the form. Where is the actual activity happening, and which country should get the taxes out of the profits which get generated from that activity. So the recommendations are aimed at ensuring that the jurisdiction that has an economic significance to the business and uh, which actually contributes to the profits, that country should get the right to tax such profits, and artificial arrangements should not take away that right. So the focus of BEPS is curbing fiscal avoidance and evasion, as against the focus of the treaties earlier was freer investment flows. But now there's a definite shift, and I think the aim or the purpose is to eradicate double non-taxation, as was happening in the case of Apple. There was no taxation. The aim is to end treaty abuse and to also ensure that the profits are taxed at the place where value creation takes place. Uh, and the idea is to ensure that if you implement BEPS action plans, it will ensure sustainability of consensual framework to eliminate double taxation. Because what can happen is, suppose countries allow this thing to happen, So some countries will benefit, other countries will stand to lose out, and then there will be unilateral decisions by countries to impose taxes, and which will definitely not be good for the trade in the longer run. So one of the objectives of BEPS is also to ensure that there is a level playing ground for smaller businesses. Now with the BEPS, the residence versus source debate has again reignited. And if you looked at the last slide, the stress is on giving the right taxation rights to the country where the value is created. So the thinking is again gradually shifting to the source-based approach. It conforms to the benefit, and as I mentioned, it attaches more importance to the economic aspect. Uh, Now, if you look at what are the changes which have happened in India, we'll come to it a little later. But the point I'm trying to say is because of this BEPS action plan, there have been changes in the domestic law, and these changes India has already implemented in the last 2 or 3 uh, budgets. They've made changes in the domestic law, and we'll see what all changes have been made and pursuant to what all action plans. India has introduced equalization levy. India has introduced the concept of significant economic presence, primarily with the view to tax digital companies. India has expanded the definition of business connection. There is a limitation on the interest deduction when you pay it to a associated enterprise. India has introduced the concept of OM when it comes to residency of foreign companies. India has introduced CAR and obviously indirect taxation on capital gains. Now, a quick look on the OECD BEPS action plans. So there are 15 action plans which the OECD finalized, and we'll take a overview of all these action plans. The time won't permit to go deeper into individual action plans, but the idea is to just let you know that what all action plans have been recommended by the OECD, and what pursuant to that, what all changes have happened in the domestic law as well as in the tax treaties. The first action plan is on the digital economy. So the countries realize that with the advent of technology, with the advent of high-speed internet, a lot of transactions can be done over net. There is e-commerce, uh, there is mobility, there is data availability, and which has actually uh, pushed aside the requirement of a physical presence. You don't need a physical presence. We're doing this webinar today without being at one location, and this all is possible because of this technology or the advancement in the technology which has happened. And I think with this lockdown, uh, one would have realized what is the significance of a digital economy. Today, you can order anything sitting at your home, and that will get delivered to you. I mean, with the markets not opening, people were uh, still able to order things that they needed. and that's the power of digital economy. Now, the only the with this digital economy, it also brings its own share of tax issues. So a company can sit in Mauritius, operate an e-commerce website, sell goods, and arrange its affairs in a manner that it doesn't pay any taxes in India, even though all the sales or significant amount of sales happen in India. So that's something which the world realized, that that's something which needs to be addressed, because if you don't tax a digital transaction, uh, you are compromising on the neutrality, and that's where this action plan was put as number one. So this action plan did not come up with any uh, change, or did not recommend a change in the tax treaties per se, but they recommended that domestic laws could be amended. But the work on this action plan is still uh, work in progress. They haven't come up with the final recommendations as such. But what they said, that in the interim, uh, countries can look at introducing significant economic presence as a basis for taxation. Countries can look at introducing equalization levy, digital withholding tax, or digital service tax. Now, these are unilateral measures, and this is bound to create some confusion. I mean, if you've gone through today's newspapers, you would see that US is objecting to India's levy of equalization levy, or India's introduction of equalization levy, and they've constituted a team to study that, because most of the US companies will get hit because of that equalization levy. So that was action plan one. The action plan two aims to neutralize the effects of hybrid mismatch, dual residency, uh, so tax credit. So you could have situations where company A invests in company B in another country, and while the return on that investment in one country is treated as interest, while in the other country is treated as dividend, and both the countries will have a different tax regime, and multinationals could actually plan their affairs in a manner to take advantage of these different tax systems. So uh, this was another action plan which looked at these scenarios, and then recommended changes. Action plan 3 recommended changes on CFC rules, or controlled financial corporation rules, and we've seen how CFC rules were subverted by Apple. Uh, Action plan 4 talked about interest deduction. Uh, so in a country where there were high tax rates, uh, multinationals could arrange their affairs in a manner that they put in higher leverage or higher debt in that country, so that the taxable profits are lower, and they could gain advantage of the interest payouts because of the lower withholding tax rates. India has put a limitation on this by introducing Section 94B, where they have limited the tax deduction on interest payments to 30% of EBITDA, and this is pursuant to this action plan. Action plan 5 is essentially reporting of harmful tax practices which countries may be following, and this also included countries having patent box regimes, or countries having very low taxes, or countries even having a system where they could agree for a lower tax rate with companies and all that. So there is a reporting mechanism which has been put in place. The idea is to bring in more transparency and ensure that there is substance in those countries where multinationals put their offices. Uh, and then there is Action Plan 6, which is largely focused on preventing treaty abuse. So this is something which has been built in almost all treaties now. So whosoever have signed a multilateral instrument, their treaties will generally have this uh, treaty abuse clause, and so treaty shopping would be essentially a thing of past now. Then they have also looked at the permanent establishment definition, and they have tried to plug certain gaps there, and they have redefined the thresholds, and so as to ensure that the source country does not lose out on the tax revenues. Action Plan 8, 9, 10 are more to do with the transfer pricing uh, strategies that the companies employ. So Action Plan 8 looks at intangibles and prescribes transfer pricing rules to prevent base erosion. Action Plan 9 relates to capital related high risk transactions, and Action Plan 10 talks about other high risk transactions. So we're not covering all this in detail in view of the time that we have, but the idea is to give you a sense of what all action plans are all about. Action Plan 11 is about collection of data. So BEPS process is not complete unless countries collect data as to what is happening in those jurisdictions, and then they analyze that data and accordingly uh, do a tax policy or tweak their tax policies. Action Plan 12 is about disclosure of tax planning. So taxpayers are now required to disclose aggressive tax planning arrangements. Uh, Action Plan 13 is about TP documentation, and we have seen how that all has increased in the last couple of years. You have master file, you have local file, you have country by country reporting. Action Plan 14 is about dispute resolution. So if you have all these things in place, there are bound to be disputes, and so it was felt that uh, there should be a robust mechanism to resolve disputes. So today you have competent authorities who resolve disputes through a mutual agreement procedure, but those disputes could take years, and so this plan actually tries to lay down a mechanism wherein those disputes are resolved in a time-bound manner. And Action Plan 15 is the most important one, which actually is a very innovative way of bringing a change in all treaties almost simultaneously. So as you would know, these treaties are all bilateral treaties. And with this BEPS action report, which recommended several changes in tax treaties, for countries to go and bilaterally amend all those treaties would have been an Herculean task. And therefore uh, it was felt that there should be a multilateral instrument, which if the countries agree, then uh, their treaty should automatically get amended. Obviously, there were safeguards built in, and there were several options which were given to countries to choose from. so that different countries can take different options and they are not bound by a single decision. So that's the way a multilateral instrument was devised, and that has now gained significance on account of the fact that these multilateral instruments are now effective for India as well, and close to 28 or 29 countries with which India has tax treaties. There, the tax treaties now stand amended with effect from 1st April 2020 on account of the provisions in this MLI. So I think that we will cover in the next webinar. But here I'll take another 5-7 minutes and I'll quickly take you through these action plans. So you could see that these action plans could be divided into three pillars: coherence, substance, transparency, and certainty. Uh, if you look at the yellow action plans, uh, these are the action plans where a treaty amendment is required. So you have a hybrid mismanagement arrangement. In this case, a treaty amendment is required. You have preventing treaty abuse. Yes, if you are preventing treaty abuse, you need to amend the treaties. Avoidance of PE status, again, a treaty amendment is required. And then on dispute resolution mechanism, again also a treaty amendment is required for that. Then there are these boxes in green color. Now here amendments are recommended to be made in the domestic tax laws. So these are CFC rules, interest deduction limitations, harmful tax practices, mandatory disclosure rules, transfer pricing documentation, uh, and country by country reporting. So if you see, India has pretty much made these changes in its domestic law with relation to these green colored boxes. And at the bottom, you'll see that there is digital economy. Again, on that, we've spoken that India has introduced equalization levy uh, in that context. And then you have Action Plan 15, which is the multilateral instrument. And as far as the gray colored boxes are concerned, these are boxes in which these are action plans in respect of which guidelines have been issued so that the transfer pricing studies can accordingly be done and the taxpayer as well as the tax administration follow those guidelines while devising their transfer pricing and while doing an assessment for that. So quickly on what are the BEPS initiatives that India has taken. So Action Plan 5 talked about harmful tax practices. So one has to report any preferential tax regimes that the country has. And so India has introduced patent box regime, which is in section 115 BBF. And this is basically a regime to encourage patents to be registered in India. And what India has done that if any entity which has a patent registered in India, which has been developed in India, and the R&D work has been done in India, then the royalty income on that will be taxed at the rate of 10% instead of the normal rate of 25% or 30% for the companies. Then we talked about equalization levy. So action plan that is pursuant to Action Plan 1, which is digital economy. So revenue from specified services. So we already had online advertising attracting an equalization levy at the rate of 6%. And from in the Finance Act 2020, they have introduced equalization levy on e-commerce transactions and levies on the non-resident e-commerce operators. Simultaneously, they have also said that they will exempt the income in the hands of the non-resident under the income tax law. There is a slight error in that exemption, which I guess they will rectify. But I think we are already in June. The first taxes have to be paid in July or on July 7th. And I mentioned US is already objecting to this equalization levy which India has introduced. So it remains to be seen whether this particular EL actually sees the light of the day. There are no rules which have come out on equalization levy on this new e-commerce transactions. So one will have to just wait and see how it pans out, because the first payment due is on 7th July. There are no guidelines as to how the payment has to be done. A very interesting thing, I just wanted to talk about this. There could be questions: can India introduce such a kind of levy? Now, if you look at it, there are three kinds of jurisdictions that a country has. One could be a prescriptive jurisdiction, or you might say legislative or substantive jurisdiction, which means do you have the legislative power uh, to introduce a law which taxes such kind of transactions, especially when there is a non-resident involved. One could argue that the sales are being made in India, or the sales are being made to customers in India, and therefore there is a nexus, and therefore the parliament had the legislative jurisdiction to frame a law to tax such transactions. Again, a matter of debate. The second jurisdiction is enforcement jurisdiction. Now, even if you're able to say that I have the jurisdiction to uh, uh, legislate such a levy, can you enforce such a levy? Now, this taxation is on the non-resident who doesn't have a base in India, who doesn't have a presence in India. How do you go and enforce this levy? What if the non-resident doesn't pay that tax? How are you going to send him notices? How are you going to enforce or recover taxes from him? Now, that's a very important discussion point. How will India implement this? Unlike the earlier equalization levy, where the levy was to be deducted by the payer, here the levy is to be paid by the non-resident e-commerce operator. So the Indian customer doesn't deduct that. And the third jurisdiction could be your adjudicative jurisdiction, which means whether the courts can adjudicate on such a law and whether they can enforce or ensure that whatever decision that they give can be actually implemented. So in that context, I think equalization levy will have its own share of litigation, and it remains to be seen what happens on this. And so the next issue which India did in its domestic law, the change which it made in its domestic law, is country by country reporting. So this is pursuant to Action 13. So the necessary changes in the domestic law have already been made, and I think it's been 2 years since the filings have been done. So this is again pursuant to the BEPS initiative. Then Action 4, we talked about interest deduction limitations. India has already introduced Section 94B, which limits interest deduction up to 30% of EBITDA. Uh, Now, India doesn't have CFC rules, but in the alternate, it introduced POEM as a basis to determine the tax residency of foreign companies. Uh, so that has been there since 1st April 2017. So that's again a change, I would say, pursuant to the BEPS initiative. India has introduced the concept of significant economic presence, though it has deferred it for the time being. And in the interim, I would presume it has introduced this equalization levy. And India has also expanded the definition of business connection. So even where a dependent agent habitually plays the principal role leading to confusion of contracts, uh, that could also create a business connection, even though the agent doesn't conclude the contracts per se. So even if his role is limited to convincing the foreign principal or convincing the customer in India to buy the goods of the foreign principal, he could still create a business connection for the foreign principal. So apart from that, India has already renegotiated its treaties with Mauritius, Singapore, Cyprus. India has had a new treaty with China as well. Uh, and obviously, India has signed a multilateral instrument, and this has already come into force and also come into effect, as I mentioned, with close to 28 countries. So this is what has been done at the India level. Uh, and this is something which I wanted to talk in this first session to give you a brief on what BEPS is all about and how pursuant to BEPS changes have been made in the domestic tax law. So in the next webinar, we can look at what are the changes in the tax treaties which has been affected on account of BEPS. So there's a significant change which has happened in the international tax arena on account of BEPS, and I would say that international tax has had a complete makeover, and if I use the word complicated, I think uh, I wouldn't be doing injustice, because it's becoming complicated by the day. Because you have all these international tax concepts coming in the domestic tax law, and now you just can't look at the tax treaties. You have to look at several instruments to ensure what the agreements are with the other countries. You have to look at the MLI. You have to look at India's positions on MLI. You have to look at a lot of subjective. I mean, you have to put a lot of subjective tests. There are some objective tests, but there's still lot many subjective tests. So while you're giving the benefit of a treaty, you'll have to ensure that those subjective tests are passed. India has also introduced CAR, and there is an equivalent provision in the treaty as well to prevent treaty abuse. So in a nutshell, I would say that international tax is becoming uh, very challenging, and one needs to have a good understanding of these concepts. But it is interesting nevertheless, and significant changes are happening, and this digital taxation or the digital world is going to change this further. That's my take on this. I would, with this, I would like to thank each one of you. I think today was the first day of the seminar, and I kind of missed out on introducing myself. Some of you, maybe a lot of you may be knowing me, but just for the sake of others, uh, I've been doing international tax for almost 20 years now, and I have no hesitation in saying that this has been one of the biggest changes in international tax. And to comprehend this, to understand this fully, it requires significant effort. Uh, but interesting nevertheless. Uh, and I see that a lot of changes are going to happen post COVID, because now, I mean, with the economies going down, it all remains to be seen how countries adhere to international tax agreements, or in order to mop up their tax revenues, do they override international tax agreements, or what kind of innovative taxes do they introduce? So it's going to be an interesting landscape in the next couple of years. And since these concepts are all being introduced in the last 2-3 years, and the treaties get amended with effect from 1st April 2020, there is bound to be litigation. There is bound to be confusion. But I believe that for any change that comes in, there will be confusion to start with before things start to settle down. And this is a very dynamic world. This is a very changing world. And this is something which we'll all have to cope up with. And I think as chartered accountants, as tax managers in companies, uh, changes like these will keep us uh, relevant, I would say, and companies would require all of us to advise them on the best practices that should be followed on, so that tax risks are mitigated, minimized, eliminated, and at the same time, the tax costs are also rationalized and optimized. So I'll be happy to answer or take your questions separately. You can email me, you can send me a WhatsApp. My number is 9811008421. I'll be happy to take any questions on this. And please excuse me if there are any technology issues. I would like to thank my team who's put together this webinar in a very short time. I would want to acknowledge my partners, Balwan, Bansal, and Ankit Jain. And thanks to Richa Soni, who did the PPT for me. And thanks to Jay for this, for arranging this webinar. So there could have been some technological issues to start with, but a beginning has been made, and I hope that we'll make this a better experience next time. And this being my first virtual webinar, so speaking in front of a laptop screen was becoming a little difficult, because you don't see faces around and you don't gauge their reactions. So it kind of becomes a monologue, and so I could have also faltered in between, but hopefully things will improve from now on. And thank you very much for participating in this. Look forward to seeing you again. Thank you. Thanks.